Joining me is Feroze Azeez, Joint CEO, Anand, Rathi Wealth. Feroze, always a pleasure chatting with you. You know, if we just rewind 2025 a bit, there have been so many defining moments, right? There was a sharp sell-off post the tariff announcement, then the big recovery in global markets, the AI trade, the smashing rally in metals like gold, silver, copper. There was Operation Sindhu, there was the big Air India crash. I mean, this has been, a year where we have seen so much. The list really goes on. Going forward, what according to you can be the big defining moment for 2026? I mean, I know nobody can really predict, but going forward, at least from a market standpoint, what according to you could be that one defining moment for 2026?
Good morning, Nanita. Like you said, 2025 was quite an eventful year. It made us see a lot of stuff. In 2026, I personally think from a capital market standpoint, every year will have some triggers and some events which will happen. That's how year progresses. But if you ask me what will change the trajectory of this equity markets in 2026, I would say FIIs returning, and that should happen. Is my second guess, and I would say that could create a rally which has been waiting to happen. Why do I say so? Is because 2025 has been the highest ever FI outflow. If you see the calendar year 22, FI sold about 1.25 lakh, 1.25 lakh crores, and last year, the year which is going by, they've sold 1.5 lakh crores. The subsequent year, which was calendar year 23, FIs bought 1.7 lakh crores of equity. So point I'm trying to get is when there are steep sell-offs by FIs, the subsequent year there is purchase because the active FIs sell and go. And in the same year, it goes unnoticed, DIIs bought 7.5 lakh crores. As a percentage, now FI outflow being the highest ever is still 15% of the inflow of the domestics in that specific year. This has never happened. In 2000, FIs bought 3,000 crores. In 2003, they bought 30,000 crores. In 2008 crisis, you know how much FIs sold? 52,000 crores. They've sold 3 times that in this year. And still markets have maximum drawn down 8.7%. So I'd say FI coming back would be the defining moment, and that will trigger the equity markets upwards.
Okay, so that's something to watch out for on the positive side. If you look at the FII selling, that has been more pronounced in sectors like IT, FMCG, power, consumer durables, and healthcare. But BFSI exposure has broadly stayed intact. What does this tell you about how global investors are reading into the India story right now, and where do you expect them to make a comeback first?
I think where they will come back will be the passive funds. See what's happened last year also with 1.5 lakh crore selling. Only the active guys have sold. Passive guys have bought like how. Unfortunately, the active FIIs sell so much that the passive guys' inflow seems overshadowed. So where will they buy? They'll buy index. What do they buy? They follow 2 indices, and people don't even track it. MSCI India Small Cap Index, for example, MSCI India Index, FTSE has a few India indices. Almost 80-90% of FIIs just track these indices. If I ask somebody how many, and I was speaking to a domestic fund manager who has 250 stocks in his small cap index, I asked him how many stocks are there in MSCI small cap index. He had no clue. There are 501 stocks. I asked him, why do you think a foreigner tracks 500 stocks and you track 250 stocks? He has no answers. I asked him, what is the other 250 stocks? Are you not curious to understand FIIs are keeping them in the index and you're not? So people are not tracking these 2 basic indices. So what will they buy? I think passive guys will continue to buy. The active guys will stop selling because they've sold a lot of it. And that's when the positive number will emerge, and they will not buy specific sectors. That's my opinion. That's what they've done last year as well. You see the stocks which entered MSCI small cap index with low free floats. They have done beautifully well.
Okay. So if investors were to ask you a very basic question, active or passive, after a year where stock picking was tough and returns were uneven, and now that you say that FIs will make a big comeback when it comes to passive first, which approach do you think makes more sense now, active or passive?
there's no one size fits all. To my mind, it has to be active. Unless, like US, people keep comparing to US and not even complete the sentence saying that, yeah, US may 90% of the money is index funds. India is 9 lakh crores out of 42 lakh crores. We are just 20%. So unless India's passive AUM crosses 50-60%, you should not be passive. Because passive, the whole engine is, if the money is coming into passive, they're buying the heavyweights. The heavyweights are the top 10 weights, and those top 10 weights do well. There's more weight to them, there's more money to them, more price, more weight. This is the winding cycle which US went through, and that's where index funds are doing phenomenally well, and the smartest fund managers are not able to beat, because it's difficult to beat liquidity. Okay, and liquidity chases weights, weight chases price chases liquidity. And this cycle is, unless India has not got into the cycle, that's clear. And if you look at the model portfolio, we have operated for the last 11 and a half years, it's beaten Nifty 4.12% compounded after feeding my company of 1%. So why would I go passive? If I can still beat Nifty by 4.12, people say you can buy other indices, but 90% of India's passive AUM is in Nifty and Sensex. That's the reality of it.
Sure. Let's also zoom out a bit and talk about the big growth themes that you'll be watching out for in 2026. Where do you think sustainable earnings visibility is really building up?
I think earnings growth visibility is there in A, B, C sectors, that is automobile, banking, and consumption stocks. Auto is again driven by domestic consumption. I'm very, very bullish on consumption. And why am I bullish on consumption? Because the prices have not run up. Consumption pillars have been laid by the government. The GST cuts, the corporate tax cuts, which happened a few years back. The direct tax cut has not even percolated down to the consumption it can propel. So I personally think consumption pillars have been laid, foundation has been laid, price has not moved, earnings have not transpired as much as they can over the next few years. So I'd say auto, banking, and consumption will be the places where you will see earnings better than the relative earnings growth, better than the relatively better than the other indices.
Sure, ABC, I think, we've spoken a lot about the ABC of consumption, right? Of investing, right? So in terms of consumption, it's a very wide universe. Where would you really place your bet within the consumption universe? Let's break it down a bit more for our viewers.
I would say non-cyclical consumptions as a theme is one of the best themes you can go for. In fact, there is a fund, I think it's the HDFC fund, which is a HDFC non-cyclical consumption fund, which focuses on consumption, but not the cyclicality, which some stocks or some subsectors bring along.
Okay, non-cyclical ones, that's where the focus should be. So if somebody is building a mutual fund portfolio today, for 2026, where should they focus for better risk-adjusted returns? Any suggestions here?
Yes, but if somebody is building a portfolio of mutual fund now, and if he is above 30, then I first tell him that he's too late. Stop procrastinating and actually get into it. So that's one suggestion, because quite a few people do a lot of study before they want to even dip their feet in water, and that really destroys a lot of value. Now, having given the philosophical gyan, let me come to what can one do. From a risk-adjusted standpoint, can buy multicap funds, because multicap has the flavor of all three. In our humble opinion, all the three, which is small cap, large cap, and mid cap, are all at a stage of almost an equilibrium in terms of what potential they have in store. A little skewed towards mid cap. Because mid caps have this huge benefit that all different funds buy mid cap, and mid cap there are just 150 stocks. Large cap has some degree of mid cap, multi cap has mid cap, flexi cap has mid cap of course has mid cap, small cap also has mid cap, but they're just goddamn 150 stocks with $1 trillion free float. So I personally think $1 trillion market cap, not even free float. So there is a lot of buoyancy in terms of PE P's and contractions not happening. So coming back, I'd say buying a multi-cap would be a good risk reward. And I personally think people should stop getting scared of Indian small caps because Indian small cap is not the true small cap. It's in the top 500 companies, mutual funds finish all the stocks. 100 large cap, 150 mid cap, and 250 small cap. The rest of the 2000 traded stocks are all considered not even in the small cap category. MSCI has 500 small cap stocks. So don't be too intimidated with the word. English word is still called small cap. But 8, 10 years back, the largest small cap was 8,000 crores. Today it's about 40, 50,000 crores market cap.
Okay. Yeah, I think they tend to get a little scared because, if you look at the small cap index, it has lost some around 6% or thereabouts, even though if you look at the headline Nifty index, at least we are ending with gains of some around 10% or thereabouts. So that was one question I was going to ask, but then you've already answered it. Feroze, we cannot not talk about the metal rally, of course, be it gold, silver, even platinum for that matter, and even copper. For an investor looking at this space now, how do you make the most of this rally without getting caught at the wrong end of the cycle? Look at silver. I think we've discussed silver earlier as well, where you pointed out that you prefer gold as a wealth creation asset. But silver, the rally seems to be, not really halting. $83, that was crossed on the silver spot prices today itself. How does one really look at this entire rally? What kind of an asset allocation strategy should one adopt, at least when it comes to some of these precious metals?
Anand, to be honest, coming one small point on the small cap index, like it is ending this calendar year at negative. If you look at the previous year, it makes up for it. Small caps or any equity instrument or a segment of the instrument cannot give you linear returns, right? And that's why you deserve 14, 15% return and not 7% return to accept the non-linearity of the instrument. And small caps are a little more non-linear than large caps. Coming back to the metal rally, like you said, it shocked me for sure. Right, the last time we spoke, silver was at $50 troy ounce, if I'm not wrong. So now we are at 77 today. Right, 77, 78. That's a large move in a span of a month and a half. But it is to my mind, I have been shocked. And there's one listed company which has silver as a byproduct of their mining. They hedge their positions at $36, if I'm not wrong. So if the guys who do it for a living couldn't guess this rally, then who am I? So point I'm trying to make is silver has this unique attribute of giving 10-year return in 1 year and then relaxing for the 9 years. This is what an investor needs to understand. And then invest or not invest is a separate story. It gave 13 years of negative return in this century. 13 years. But you have the patience to buy at 77 and maybe see 100, sell it off. So it's a trading instrument, not an investing instrument. An investing instrument which has such non-linearity. That small cap, we are perturbed by about a 6% negative move for a year. But silver from 2011 to 2024 gave a negative return in rupee terms as well, in spite of the rupee depreciation over the period.
Yeah, that's a very interesting point you made. Of course, 13 years of negative returns, and of course, and as you brought out the comparison with Nifty small cap, 1 year of negative returns, and that has got investors nervous. But let's talk about gold. That is, of course, largely looked upon as a wealth creation asset. The ownership itself is evolving, right? We have digital gold alongside ETFs and physical gold. It's a very basic question that I get asked very often, and I want you to answer it, is the fact that, how should investors think about these newer formats, especially in terms of costs, risks, and regulation? Because, people tend to look at gold investment in terms of physical gold, but then now we have so many other options. What are some of the risks and costs, regulations, etc., associated with them, and should one really look at the other means rather than physical gold?
I think you should always opt for other means because physical gold is the most inefficient way of buying and selling it. If you buy and store it for your children, grandchildren, then it's okay. The disparity seems to fade off. But if you're looking at buying it and maybe selling it at a point in time and seeing it as a financial instrument or an investing instrument, you should definitely look at ETFs and gold funds. But one thing which you have to always check is what are the premium those ETFs are quoting at. Sometimes what happens is whenever you cut a check to an ETF or click a button and buy an ETF, the ETF needs to actually go buy the physical gold. So if the spot market is not giving, there is premium in the spot market, then it becomes a challenge. So you when you buy ETFs, you have to be very careful in terms of buying premiums. There's one client of mine who insisted to buy silver. He was going to buy ETF. I said, I'll not let you buy the ETF because the ETF was quoting at 20% premium. So gold, silver went up 24%, but the guy made only 4% because the premium vaporized. So coming back, ETF, gold, one check you have to see whether it's quoting at a premium or at a discount. It's generally never at a discount. Sometimes it's astronomical premium. Stay away. Sovereign gold bonds in the secondary market, you will get at some premium. Those are still very, very good instruments, not in the primary market. And if these three are to be replacing your debt component, please don't replace it with your equity component. Even from 2015 till now, it doesn't hurt me as a Feroze. I don't have gold exposure, to be honest. But my IRRs are greater than gold in spite of the rally from 2015. It is just about a 14.5% compounded return which gold has given, even after this rally, for which I had to wait for 10 years. From 2018, it has done well, 16.5%. So use gold as a debt replacement more than an equity replacement, especially at this price with staggering as a strategy.
All right, that's some valuable advice coming in from Feroze. But Feroze, couple of more questions in terms of your outlook for 2026. Do you agree that the market, while we are expecting FIIs to make a comeback in a big way next year, but do you agree that the market may need to consolidate for a few more quarters before valuations become attractive enough to pull FPIs back, and that too in a meaningful way?
I'm not saying they'll come back in a big way. They will come back. When they come back, they are price inelastic. That means if they come back, they don't look at price, they buy and move price upwards. There is 90% index future short position of FII, which will trigger some degree of short covering, hopefully. Second thing is the kind of gamma and delta options book. Now, SEBI actually publishes the delta of the total India's option book. So that's a very useful piece of information which people don't track. So I'm not saying they will come back in a big way. Even if they do come back, the price movements could be larger than the rupee value they bring in. That's my current take. Now, will it consolidate for some more time? The market, in my opinion, the market has consolidated for long enough. I was speaking of 27,000, 28,000 for this year. I was speaking about 27, 28,000 for this year. And that's the number which I'm looking at.
Okay, 27, 28. Okay, that's a good ballpark figure to work with. Last couple of questions then. Domestic flows have been the big shock absorber this year, right? But I know you've given a 27, 28,000 kind of, levels to really work with on the Nifty. But if 2026 for some reason turns out to be a low return year, do you think domestic liquidity itself could be tested? Could that be a worst case scenario to look at for 2026? And I'm at the risk of sounding a bit too pessimistic, but when we talk about the risks going forward, could this be a risk factor that could emerge?
Yes, it can. The whole thing is 7.5 lakh crores coming from domestic institutions in a single year, where FII's maximum sale ever has only been 20% of the purchase they did. Of course, domestic liquidity can dry up, but it looks unlikely because fundamentally, if you look at the small cap inflows, which we track very closely on a daily basis, because that's a barometer of a trend changing. If the trend has to change, the first thing which has to stop getting inflows is a small cap fund. That doesn't seem to be happening. So that can actually be a dent in the market. But what risk are we talking about? If you're talking about 8, 10%, 15% corrections, that is going to happen every year and has happened every year. On 1st of January, if I went back on all the days of 1st January, if I said this year markets will test a peak to trough of 15%, I would have been right 9 out of 10 times. So markets always will give you peak to trough of 10, 12, 14%. Anything more than that, 20, 25% correction is what I call risk. Every year something happens. Every year I don't call that risk. That is an expectation then. I don't see any sharp moves downwards like 20, 25%. That's ruled out for 2026, and there is a long list of reasons why. I'll not bore the audience with it.